Yeah, well, certainly. It's as I said, it's one where it must be addressed in the investment strategy of the fund and must be acknowledged by the trustees. And the trustees would need to put in place either plans to contribute more money to the fund, and as such, then invest that across different asset classes. Perhaps, and we're assuming here that the property is being bought outright and we haven't borrowed money to purchase a property. Then you have a degree of rental income which is coming in from that property. Some of that will be taken up in property maintenance, of course, as we all know. However, you would want to see trustees also taking the yield from that property and investing it across different asset classes as well, such that over a period of maybe 10 or it might even be 15 years, the trustees will address that lack of diversification and liquidity. Hopefully for the point in time when they're ready to retire and they need to fund an income stream, that property will be a significantly smaller percentage of the total fund assets which are available to fund that retirement income stream. Yes, they do have to have one, and not only do they have to have one, but they have to demonstrate that they've implemented it as well. In other words, they have to invest the assets of the superannuation fund in accordance with the investment strategy which they've set out. So they have to set themselves an investment objective, some target that they want to achieve on an annual or 3-year or 5-year basis, whatever it is they choose to set. And then the strategy then spells out how they intend to invest the superannuation money in order to achieve that objective. It's something that the auditor each year of the fund will sign off on to say that the fund has invested in accordance with the investment strategy of the fund as it was set at that particular time. So it's an important document, and it's one that I think that is overlooked by trustees often because they perhaps aren't appreciative of the importance of the document. The other point I suppose to make about investment strategies is, though, that it is the trustees who are writing the investment strategy. They are creating the investment strategy. So, and it doesn't no more than describe how they want to invest the assets of the fund. So in some sense, it is really just a compliance issue or requirement, because if they decide that they want to invest in an asset which doesn't fit in with their investment strategy, then all they need to do is to change their investment strategy to accommodate that new investment before they make the investment, and then they'll continue to comply with the legislation and their trustee obligations. But it's something that I think is sometimes thought about after the event rather than as a forward planning measure. The amount of cash could come about from a number of reasons. We are using Australian Tax Office data here, which is collected at 30 June. So the first thing I guess you could observe is that a lot of SMSF members make large cash contributions just before 30 June, so that a few percentage of that may well just represent contributions which have just been made to the fund and haven't yet been invested. I think that the higher percentage, though, there are two other things that are reflected, and I think one is that yes, they are at the moment more cautious post GFC than what they perhaps were prior to the global financial crisis. But also an interesting statistic which has just come out is that a very high percentage of all pension assets in the superannuation sector are actually held in self-managed superannuation funds, well over 50%, perhaps even a higher percentage than that of all the assets in the whole superannuation sector are actually assets held within self-managed super funds. And one of the things you do need to do if you're running an income stream, particularly inside a self-managed super fund, is you have to carry a higher level of cash to ensure that you can meet your pension liabilities as they fall due. Typically, 2 years' worth of pension payments per pensioner within the fund would normally be held in cash in order to ensure that the fund is not being forced into selling assets in order to meet their pension requirements each year, perhaps at a time when it's not a good time to sell particular assets. So there could be that, and it could be, yes, that they are being a little bit more defensive at the moment. On the other hand, I've certainly come across older self-managed super fund trustees who claim to be conservative investors, and that's where they have 70 to 80% of their fund in direct shares, but those direct shares are the 4 banks and BHP and Woolworths. And so that's their version of a conservative investor. clearly quite a different idea of a conservative investor compared to APRA or ASIC. But at the whole, they do seem to be a little reluctant at this stage to dive significantly back into listed securities, but that is happening slowly over time.